The plane lands. New country, new life. Your salary, your savings, your pension pot, they all landed with you. And in the next 12 months, 5 rules you have never heard of will quietly decide what happens to every one of them. Get the rules right, and the move costs you almost nothing. Get them wrong, and the penalties start before you have even unpacked. Last time, we saw how the country you leave can chase you for years. Today is the other half of the story. What the country you arrive in does to your money from the very first day. 5 rules. Miss one, and it will find you. Here is the part nobody tells you at the airport. In most countries, your tax life does not begin when you get a job, or open a bank account, or file your first return. It begins the day you become a tax resident, and that day is usually much earlier than people think. Cross the day count line, sign a long lease, move your family in, and the clock may already be running, backdated to the day you arrived. That starting date matters because everything you earn worldwide from that day forward is usually on the table. Not just your local salary, the rental income from the flat you kept back home, the dividends landing in your old brokerage account, interest on savings you left behind in the old bank. Most rich countries tax residents on worldwide income. The moment you become theirs, your whole financial life becomes their business. That is the canvas the 5 rules are painted on. Rule 1. Your salary is taxed where you do the work, not where the employer sits, not where the money is paid, where your hands and laptop actually are. Work remotely from Lisbon for a London employer, and Portugal, not Britain, has first claim on that salary. This trips up remote workers constantly. Keep your old job, move abroad quietly, and you may create 3 problems at once. Your employer is running payroll in the wrong country, you owe income tax where you now live, and your old country may still be withholding tax it no longer has a right to. Getting the withheld tax back means paperwork, treaties, and months of waiting. A few countries soften the landing. New arrivals can get special regimes, flat rates, partial exemptions, a few years of reduced tax to attract talent. They exist, but almost none of them apply automatically. You apply, on time, in the first months, or you lose them. Rule 1 has a deadline. Rule 2. Your investments get a new starting line, or they don't. When you become a resident, some countries treat your shares and funds as if you bought them on arrival day, at that day's price. Canada does this for newcomers. Australia too. Old gains stay out of reach and only growth from arrival is taxed. That is the friendly version. Other countries carry over your original purchase price. Arrive holding shares you bought cheap 15 years ago, sell them next year, and the new country may tax the entire 15 years of gain at its own rates as if it had been there all along. Same portfolio, wildly different bill, depending purely on where you landed. And one more twist. Some countries treat foreign investment funds worse than local ones, with punitive rules and extra reporting. The fund that was tax efficient at home can become a slow leak abroad. The lesson of Rule 2. Know the starting line rule of your new country before you sell anything, and sometimes before you even move. Rule 3. Your pension has its own passport, and it did not emigrate with you. The pot you built at home usually stays in the old country's system, taxed under the old country's rules, with a treaty deciding how much of each payment your new home is allowed to touch. 3 outcomes are common. Best case, the treaty sends the taxing right to your new country, and the old one lets go. Middle case, the old country withholds a flat 15 or 25% at the source, forever, and your new country gives you a credit. Worst case, both tax the same pension, and you spend years claiming refunds. And be careful moving the pot itself. Transferring a pension across borders can be treated as a full withdrawal, taxed in one shot at your highest rate. Some transfers are protected by special schemes. Many are not. One wrong form and 30 years of saving meets one very bad tax year. Rule 3 rewards the person who reads the treaty before touching the pot. Rule 4. Your bank tells on you, automatically. More than 100 countries now share financial account data every year under a system called the Common Reporting Standard. Open an account in your new country, keep the old ones at home, and both tax offices soon hold a mirror image of your finances. The era of the quiet foreign account is simply over. Banks react to your move too. Update your address to a foreign one, and some banks will restrict your account or close it because serving foreign residents means paperwork they would rather avoid. Meanwhile, several countries make you declare your foreign accounts and assets yourself. Spain's declaration kicks in at 50,000 euros of foreign assets, and the penalties for forgetting it have historically been brutal. Rule 4 is not about hiding anything. It is about symmetry. They already know. Declare cleanly, on time, and the transparency works for you. Stay silent, and the same data becomes the evidence. Rule 5. The penalties are for silence, not for owing. Nearly every horror story in expat tax starts the same way, not with unpaid tax, but with an unfiled form. Foreign asset declarations, first-year registrations, special regime applications, departure and arrival notices. Most have deadlines inside your first year, some inside your first months, and the fines are often fixed sums that have nothing to do with your income. So here is the landing checklist. Screenshot this. 1. Find your residency start date in writing. 2. Register with the local tax office before the first deadline, not after. 3. Apply for any newcomer regime immediately. They expire. 4. List every foreign account, fund, and property and check which declarations they trigger. 5. In year 1, spend 1 hour with a local cross-border advisor. It is the cheapest insurance your move will ever buy. 5 rules: salary, investments, pensions, banking, deadlines. Master them and your money lands as softly as you do. But there is one part of this story we only brushed past. The moment you change your address, some banks do not just grumble, they freeze the account. Cards declined, transfers blocked, savings locked behind a compliance wall, sometimes for months. Why banks treat immigrants as risks, and the 3 moves that keep your accounts alive. That is the next video, on your screen right now. Watch it before you tell your bank anything.